Stop everything you're doing. Shut the extra tabs. Silence the background noise. What I'm about to walk you through is not a conspiracy and not guesswork. It is math. Cold, unforgiving, unavoidable math that points to JPMorgan Chase standing on a collapsing platform with the noose already tightening 4.2 billion ounces. That is the estimated size of JPMorgan's silver short position. That is the estimated size of JPMorgan's silver short position based on analyst calculations derived from OCC derivatives data and CFTC commitments of traders' reports. Now, let's frame that number properly. Global silver mining produces roughly 800 million ounces per year. Divide 4.2 billion by 800 million and you get 5.25. JPMorgan is effectively short more than 5 years of total worldwide silver production. Here's where the situation becomes genuinely alarming. The amount of registered silver currently available for delivery on the COMEX is about 123 million ounces. JPMorgan's estimated short position is roughly 34 times larger than the entire deliverable supply. This is not a battle between David and Goliath. This is David versus a god. And the god loses because mathematics does not negotiate. When the numbers don't reconcile, something snaps. Either JPMorgan breaks or the price does. What I'm about to demonstrate using historical precedent from 1,980 mathematical modeling based on the Hunt Brothers silver squeeze and an analysis of today's market structure is what happens when 4.2 billion ounces are forced to cover against only 123 million ounces of available supply. The number you arrive at is 347, and the timeline is 21 days. Here's how the logic unfolds. Before continuing, it's critical to clarify what this is and what it is not. This is not a leaked file. There is no insider access, no confidential communication, no hidden documents. The foundation here is entirely public information data from the Office of the Comptroller of the Currency CFTC commitments of traders reports, daily COMEX warehouse statistics, and long-standing analyst estimates from market veterans. What follows is scenario-based analysis and mathematical projection. What happens if present trends persist? What happens if JPMorgan is compelled to unwind its estimated short exposure under current market constraints? This framework relies on historical comparisons, supply and demand realities, and price elasticity modeling. Could this analysis be wrong? Yes. Could the estimated size of the position be inaccurate? Also yes. Could real-world events unfold differently than projected? Absolutely. But the calculations themselves are valid. The data can be verified. The historical precedents exist. So this is an if-then proposition. If JPMorgan is short approximately 4.2 billion ounces, and if that position must be covered within a compressed time window, then this is what the math and history suggest will occur. You decide for yourself whether this scenario makes sense. Now let's walk through the data. The Office of the Comptroller of the Currency releases a quarterly publication known as the OCC Quarterly Report on Bank Trading and Derivatives Activities. In the most recent edition, Q4 2025, the report shows that U.S. commercial banks collectively hold precious metals derivatives with a notional value of more than $1 trillion. The data is broken down by institution, and JPMorgan Chase sits at the top with the largest exposure. The report does not separate gold from silver, and it does not disclose whether these positions are net long or net short. That gap is where additional data sets come into play. The CFTC publishes weekly commitments of traders' reports detailing positions in COMEX futures by participant category. In silver, the commercial category, banks and mining companies combined, currently carries a net short position of roughly 350 million ounces, and that figure only reflects COMEX futures. It excludes over-the-counter derivatives options and positions tied to the London bullion market. Analysts who have followed JPMorgan's activity across these venues estimate its total silver short exposure at around 4.2 billion ounces. This figure is not pulled from a single source. It is the result of long-term tracking delivery analysis and reconstructing positions from multiple public data sets. Is that number perfectly precise? No. Could it be overstated by 20 or even 30%? Possibly. But even if the true exposure were only half that size, the outcome does not materially change. So why would a bank accumulate a short position of this magnitude? This is not a one-time speculative wager. It is the result of decades of ordinary banking activity layered on top of itself. First is market making. JPMorgan acts as a market maker in precious metals, selling to buyers and buying from sellers with imperfect hedging at massive scale. Second are mining company hedges. Silver producers routinely sell future production forward to lock in prices. JPMorgan takes the other side and hedges by selling futures, adding to short exposure. Third is hedging for commercial and industrial users seeking protection against rising prices. Fourth is proprietary and balance sheet positioning allowed under regulation, slowly compounding exposure. None of this violates regulations. None of it implies bad intent. It is routine financial activity. But when carried out over 20 or 30 years, the positions compound. Now in 2026, with silver trading at $90.56, an all-time high and up roughly 195% year over year, that accumulated short exposure is deeply underwater. Now let's look at what the numbers imply for potential losses. Assume JP Morgan built the bulk of its short exposure at an average price of $60 per ounce. That assumption is conservative given that much of the position was accumulated over many years when silver traded in the $20, $30, and $40 range. At today's price of $90.56, the loss per ounce is $30.56. Multiply that by 4.2 billion ounces, and the result is $128.352 billion in mark-to-market losses. $128 billion. That is not noise. That is not something that can be absorbed quietly. JPMorgan Chase reported total Tier 1 capital of roughly $252 billion as of Q3 2025. Losses from silver alone would therefore consume about half of the bank's core capital base. Yes, accounting rules give banks flexibility in how derivative losses are recognized, and yes, not all losses immediately hit regulatory capital. But that flexibility is finite. If silver continues higher, those buffers are eventually overwhelmed. If silver pushes to $100, $120, or $150 per ounce, losses accelerate. At that point, regulators intervene. The bank is told to reduce risk. Reducing risk means closing short positions. Closing short positions means buying silver. And buying billions of ounces in a tight market sends prices straight up. That is the trapdoor. The trigger that drops that trapdoor does not have to be a single event. It can be set off by any one or a combination of three systemic stresses. Let's walk through them. The first is a COMEX delivery failure. The March 2026 silver contract shows open interest equivalent to 57 million ounces. If just 20% of those contracts stand for delivery, demand reaches about 101 million ounces. Registered COMEX inventory sits near 123 million ounces. If 30% stand, demand jumps to 152 million ounces. If 40% stand, as occurred in January, demand reaches roughly 203 million ounces. At that point, the exchange cannot deliver. COMEX would face two options: declare force majeure and cash settle, or source physical silver at any price. A force majeure declaration would shatter confidence in paper silver. Physical premiums would surge. Futures might settle at $90 while real metal trades far higher. JP Morgan's exposure is paper, but losses are set by physical reality. They cannot close shorts at $90 when the real market clears far above that level. They would be forced to source actual bars. Once a bank of that size enters the physical market seeking hundreds of millions of ounces, prices go vertical. That is the first crisis. The second crisis is a regulatory capital call where losses force action. Those losses are approaching the bank's entire capital base. Regulators will not permit JP Morgan Chase to sit on exposures of that size. At some point, a directive is issued: reduce your silver exposure or raise roughly $50 billion in fresh capital. Raising $50 billion on short notice is extraordinarily difficult, especially when the reason is massive losses on silver shorts. Investors do not rush to fund a losing position. That leaves only one real option: cover the shorts. And covering means buying on the order of 4.2 billion ounces. Here's the catch. When regulators issue such directives, they are not public immediately. But markets are not naive. Trading desks notice unusual buying. Competitors connect the dots. Hedge funds sense vulnerability. They front-run the covering. They buy ahead of JP Morgan, pushing prices higher and forcing the bank to pay progressively more. This is the regulatory cascade. The act of reducing risk amplifies risk, because the unwind itself creates a self-reinforcing feedback loop. That is the second crisis. The third is the China factor. China implemented silver export restrictions, effective the 1st of January 2026. The motivation is straightforward: accumulation. Shanghai silver trades around $96, while COMEX sits near $90, a $6 premium. In a normally functioning market, arbitrage would erase that spread, but it persists. Silver can flow into China, but it cannot flow out. The market has become a one-way valve. The premium is expanding. In December, it was $3. Now it's $6. By February, it could be $10, $15, even $20. Every dollar of premium incentivizes arbitrageurs to drain COMEX inventories. They buy metal at $90, ship it east, and sell higher. The vaults bleed, and as inventories fall, silver available for JP Morgan to cover shrinks further. At the same time, if China is accumulating and pricing strongly suggests it is, then China is competing directly with JP Morgan for the same limited pool of physical silver. JP Morgan needs billions of ounces. China may be seeking another billion or two. Two buyers of that magnitude chasing scarce supply do not produce linear price moves. They produce exponential ones. China does not face a deadline. China can accumulate patiently. JP Morgan cannot. JP Morgan faces regulators' delivery requirements and margin pressure. China can wait. JP Morgan cannot. China waits. JP Morgan pays. That is the third crisis. Each pressure alone might be survivable, but all three converging is not. COMEX delivery strain plus regulatory intervention plus Chinese demand equals checkmate. All available evidence points to all three pressures unfolding at the same time. So now let's examine what happens if a major bank is forced to cover an estimated 4.2 billion ounces of silver within a highly compressed window. I'm going to model a 21-day scenario. The reason for using 21 days is simple and tied directly to the March silver contract timeline. That period roughly spans from first notice day for the March silver contract on February 26 to the conclusion of March deliveries on March 31. If in late February it becomes clear that March delivery may fail, regulatory scrutiny is intensifying, and the China premium is accelerating, then a hard deadline exists. Positions must be reduced before March ends. Before walking through the timeline day by day, it's critical to understand why this scenario is mathematically defensible. To do that, we need historical precedent. The closest parallel is the 1,980 silver squeeze involving the Hunt brothers. In 1979, they accumulated roughly 200 million ounces through futures and physical purchases, while global annual production was about 300 million ounces. In other words, the Hunts controlled close to two-thirds of 1 year's global silver supply. Silver traded near $6 per ounce in early 1979. By January 1980, it surged to roughly $50 per ounce. That represents an eightfold increase over about 12 months, an 800% move, driven by supply imbalance and forced buying pressure. Now, scale that framework to today. The estimated short exposure under discussion is about 4.2 billion ounces, while annual global silver production is roughly 800 million ounces. That means the short position represents approximately 5.25 years of global supply. The Hunts were long about 0.67 years. Relative to supply, today's imbalance is nearly 8 times larger. If an imbalance equal to two-thirds of 1 year's supply produced an 800% price increase, what does an imbalance equivalent to more than 5 years imply? Even applying linear scaling, which is already conservative, an 8 times larger imbalance suggests an 8 times larger price impact. 800% multiplied by 8 equals 6,400%. Applied mechanically to a $90 starting price, that would imply silver near $5,800 per ounce, which is obviously unrealistic and not the claim being made. The point is scale. Even if modern market structure reduces the effect to 1/10 of the Hunt brothers episode, the result is still a 640% move to roughly $670 per ounce. The modeled scenario of silver reaching $347 represents a gain of about 385%, roughly 60% of the Hunt brothers' impact when adjusted for relative position size. That is not extreme or sensational. It is restrained by comparison. And if covering is forced, it does not require a year. Under pressure, it can unfold in weeks. Before I walk through the individual days, I need to pause and ask you something. If this analysis is useful, if this kind of scenario planning helps you see what may be developing, you need to subscribe now. I'm not just saying silver will go up. I'm breaking down the mechanics of how markets fracture step by step, including the why, the how, and the timing. Over the coming weeks, I'll be monitoring the evidence in real time. If JPMorgan's buying accelerates, if COMEX inventories continue to fall, if the Shanghai premium widens, you'll see the process unfolding. If those signals fail to appear, then the scenario was wrong. This analysis only has value if the data is watched as it evolves. So subscribe and turn on notifications. Now let's move into the 21-day timeline. Day 1 is February 26, first notice day for the March silver contract. Long holders must declare delivery intent. Under normal conditions, only 5 to 10% do so, roughly 25 to 50 million ounces, which is usually manageable. But conditions are no longer normal. The Shanghai premium is already elevated. Chinese export restrictions are active. Industrial consumers are anxious about supply. Instead of 5 to 10%, 25% of longs stand for delivery, representing 127 million ounces. Registered COMEX inventory stands at 123 million ounces. The exchange is immediately short by 4 million ounces, creating instant delivery stress. When trading opens, silver gaps sharply higher, jumping from $90 to $94 within the first hour. COMEX releases an emergency statement saying it is assessing supply options and contacting holders of eligible inventory to encourage conversion to registered status. The announcement fails to calm the market. Silver finishes day 1 at $96. Inside, JPMorgan alarms are ringing. They see the delivery numbers and understand their exposure. They begin covering. On day 1 alone, JPMorgan buys an estimated 50 million ounces across futures options and OTC instruments. Normal daily volume is around 8 million ounces. This activity is more than 6 times typical levels. The price impact is partially masked because buying is spread across multiple venues, but it is unmistakable. The session closes at $96. Day 2 is February 27. COMEX announces it has secured 20 million ounces, converted from eligible to registered inventory, lifting registered supply to 143 million ounces. On paper, March delivery now appears covered. Silver initially sells off on the headline and opens at $94. By midday, the market connects the dots. March is covered only by exhausting the buffer. May and July contracts also carry heavy open interest. If 25% stood for March, later months could see even higher delivery demand. The exchange has used its safety margin. Silver reverses sharply and closes the day at $99. JPMorgan keeps buying. Day 2 purchases are estimated at 60 million ounces as the bank races to reduce March exposure before deliveries begin. Futures are bought and offset volume explodes to roughly 10 times normal levels and the pressure becomes obvious to the broader market. Other traders notice. Hedge funds identify the pattern and begin front-running the expected JP Morgan demand, buying ahead and forcing prices higher. Day 2 ends at $99. Day 3 is February 28. The Shanghai premium detonates. Shanghai opens at $112 while COMEX trades at $99, widening the premium to $13 per ounce. Arbitrage desks rush in. Traders buy every available COMEX contract with the intention of taking delivery, shipping metal east, and selling into the premium. COMEX reports registered withdrawals of 8 million ounces in a single session. Inventory drops from 143 million to 135 million ounces before March deliveries even begin. Silver opens at $102. By midday, it trades at $108. Momentum takes over. Technical traders jump in. Algorithms flip long. Retail FOMO ignites. Silver closes day 3 at $115. At this point, JP Morgan is no longer executing a controlled unwind. They are reacting. Losses accelerate and the feedback loop is fully engaged. At $115 per ounce, losses are already around $75 billion, and only about 110 million ounces of the estimated 4.2 billion ounce short have been closed. That leaves roughly 4.09 billion ounces still outstanding. On day 3 alone, purchases reach 75 million ounces. The pace is accelerating. Day 3 ends with silver at $115. Day 4 is March 1. Financial media finally catches up. Bloomberg runs headlines about silver surging on supply fears. CNBC brings analysts to discuss COMEX inventories. Retail investors watching silver climb for 3 sessions begin buying aggressively. Silver ETFs see massive inflows, roughly $1 billion in one day, forcing funds to source close to 9 million ounces. Physical premiums explode. American Silver Eagles jump from a 30% premium to 50%. Dealers cannot replenish inventory fast enough. Silver opens day 4 at $118. Media attention ignites the next wave. Institutional managers approve allocations. Futures, mining stocks, and physical metal are bought aggressively across markets. Silver closes day 4 at $129. Covering continues. Day 4 purchases total roughly 80 million ounces, but the dynamic has turned hostile. The bank increases its buying, yet prices rise even faster. It is effectively running in place. At $129, losses approach $97 billion. The imbalance between buying pressure and available liquidity becomes unmistakable. Day 4 ends at $129. Days 5 through 7, March 2 to March 4 blur together. Momentum dominates. Every pullback is immediately bought. Technical levels hold, then break. Silver pushes through $130, then $140, then $150. By the close of day 7, March 4, silver trades at $162, driven by relentless demand and collapsing sell-side resistance. Over those 3 days, another 250 million ounces are closed out, yet roughly 3.84 billion ounces remain short. At $162, losses on the position exceed the bank's total capital. On silver exposure alone, the institution is effectively insolvent. Regulators convene an emergency meeting. Senior leadership is summoned to Washington. The message delivered is unambiguous. You have 14 days to eliminate the silver exposure or control of the bank will be taken. This is not a negotiation. It is an order. Day 7 closes at $162. Days 8 through 14, March 5 to March 11 mark the final phase. The bank buys everything it can access across futures, options, OTC contracts, and physical markets. Buying runs near 150 million ounces per day. The market cannot absorb that flow. Liquidity evaporates. Bid-ask spreads widen to $5, $10, even $15. Silver becomes difficult to transact. Small orders fill, large orders move prices by double digits. Volatility becomes extreme as price discovery breaks down across venues. Day 8, $174. Day 9, $189. Day 10, $207. Day 11, $231. Day 12, $258. Day 13, $287. Day 14, $319. By March 11, roughly 2.1 billion ounces have been covered. Another 2.1 billion ounces remain. The price escalation reflects forced buying, not speculative excess. At $319, with an average short entry near $60, the loss per ounce is $259. On the remaining 2.1 billion ounces, that equals roughly $544 billion in additional losses. The already closed portion has cost about $210 billion. Total losses approach $754 billion. The bank's market capitalization is roughly $420 billion. This is insolvency. What's keeping the bank alive at this point are emergency credit lines from the Federal Reserve. Day 14 ends with silver at $319. Days 15 through 21, March 12 through March 18 mark the final stretch. JP Morgan keeps buying, but this is where something finally gives. The COMEX changes the rules, raising margin requirements and imposing strict position limits. Margin requirements are raised to $70,000 per contract, roughly double prior levels, and position limits cap any participant at 5,000 contracts. These measures are intended to slow JP Morgan's buying. Instead, they broadcast panic. Market confidence collapses. Physical premiums, already 40% above paper prices, surge to 70%. The market fractures under the stress. The market splits in two. Paper silver on COMEX trades near $290, while physical silver in Shanghai and Zurich trades closer to $400. JP Morgan is now forced to source physical silver at $400 to close positions originally established around $60. The mismatch between paper pricing and physical reality becomes undeniable and brutally expensive. Days 15 through 21 become a grinding unwind. The remaining 2.1 billion ounces are closed through open market buying and negotiated settlements. Counterparties are contacted directly and offered large premiums for cash settlement instead of delivery. Some accept, others refuse. By day 21, March 18, the entire estimated 4.2 billion ounce short is closed or settled. Paper silver finishes at $347. Physical silver trades near $470. The average exit cost is roughly $190 per ounce. Total losses approach $546 billion. JP Morgan Chase survives only barely. A $200 billion emergency facility from the Federal Reserve is required. When disclosed, the bank's stock collapses 40% in one session, sending shockwaves through markets. This was not a forecast. It was a mathematical simulation of what could occur if a massive silver short is forced to unwind under time pressure. The specific prices are illustrative. Directionally, the conclusion is resilient. With global supply deficits persisting and inventories shrinking, prices north of $300 are not extreme. They are implied by arithmetic, history, and fundamentals.